All right, well, we're back and we're going to wrap up this chapter. And now we're going to be talking about factory overhead variances. Okay. As I said before, what makes these a little bit more difficult is the fact that factory overhead, unlike direct materials and direct materials and direct labor were variable costs, where factory overhead is both fixed and variable. And so we've been talking about this, going back to the chapters on process costing and job order costing, right? But when we're talking about factory overhead, some of those things are fixed, things like salaries, depreciation, right? And then there's some things that are variable, like utilities, cleaning solutions, and things along that line, right? So factory overhead costs are analyzed differently, right, than direct labor and direct materials, right? The reason being is that they have both fixed and variable components. Factory overhead costs are budgeted and controlled by separating factory overhead into its two different components. Right? Doing so allows the preparation of flexible budgets and the analysis of factory overhead controllable and volume variances. And so, if you remember going back to part one, factory overhead was broken into the fixed thing, which is the volume variance, fixed factory overhead, and the controllable factory overhead or controllable variance, which is the variable factory overhead. And so we have, all right, a flexible budget. All right, so back in the budget section, we talked about the difference between static and flexible. Right, whereas flexible takes different volumes, right, and sees what the cost would be there. Okay? Whereas a static, it just took one level and did our calculations. So I want to highlight a few things here. Right? The first thing is, right, when we talk about our standards, right? And we talked about the theoretical standard or capacity and our normal capacity. What we have done, we have set our normal capacity as 100%. Okay. And so, historically, right, when we take into account, shutdowns, weekends, vacations, and stuff like that, normally, okay, we produce 5,250 units. You guys remember how many pairs of jeans we're producing? That's right. We're producing 5,000 pairs of jeans. And so we have a difference here, okay? The numbers that we should be comparing to, all right, are 80% of our normal capacity. But when we came up, because if you remember, budgets and standards and stuff like that, they're all set at the beginning of the period, right? So we don't really know how many units we're going to produce based on demand, right? Because, we're only going to produce the number of units that we actually are selling. Does that make sense? Because it would be unwise to overproduce inventory if we're not going to sell it. Right? So we've actually produced less, okay, volume variance. We've produced less volume by 1,250, right? So we thought we were going to produce 6,250, right? But we really only produced 5,000. Again, those are output units. And so we're going to convert that output units into hours. Okay? And so if you remember, our factory overhead was 80%, per hour. Okay? And so by taking 6,250 output units, if we multiply that or converted it into hours, we'd multiply that times 0.8. And that's what we arrive at, okay, of this 5,000 hours. All right. So unfortunately, all right, these hours, okay, are not the same thing as units. Okay. So we're producing hours, 5,000 hours to produce 6,250 units. at 80%, right, we produced 5,000 pairs of jeans. We multiply that times the 80% per hour, and that's how we end up, okay, with 4,000 direct labor hours. Does that make sense? So it's unfortunate that it's 5,000, 5,000. All right. And so, all right, what we basically do, all right, we say we break this into the two parts. We have variable costs and we have our fixed costs. And so if you remember, when we have applied factory overhead, right, we took our, estimated total factory overhead, both fixed and variable, and we divide it by some sort of cost driver. Well, in this case, we're using the cost driver of direct labor hours. And so we're taking this number. Oops, that's not what I wanted to use. I wanted to use this. So we're taking the total cost, both fixed and variable, and we're dividing it by those 5,000 hours. And so we end up, right, with a application rate, or the factory overhead rate, okay, of $6 and such. And so, when we do the allocation of factory overhead, that's what we're going to utilize. So moving on, we're going to break that $6 into its two components, right? And so you can see that we have total variable cost here, okay, and we have total fixed cost here. And so if we just take this 18,000, and we divide that, all right, by the 5,000 units, okay, we're going to come up, all right, with a variable cost per unit. And that's what we do in these next slides, right? And so, here's our calculation of total factory overhead, but then we're going to break that into its two components, all right? So here's the 18,000 variable, okay, divided by the 5,000, and here's our fixed. And so we end up with, right, the $6, right, consists of variable and fixed, $6, if we were to add those together, right? Because we're going to be looking at these, right, as a controllable, right? This is going to be controllable, okay, and volume. Right. And so, yeah, they're just showing you, how we came up with the 6. Right. And so we're going to be looking at the controllable variances. All right. And so when it comes to factory overhead, do we have any control, right, over those costs? The answer is yes. All right. So what are variable factory overhead? Well, utilities are, right? And so with a utility, right, can we operate with half the lights on? Yes, we can, right? In fact, I've been to places, right, retail stores for that matter, that have turned off, right, half of their lights. Why? Well, to save on utilities, right? And so we can control those things. All right, for instance, do you have to change the oil in your car every 3,000 miles? I mean, that's what's recommended, right? But can you save money by maybe pushing that out to 4,000 miles or 5,000 miles? Yes. I mean, it might detrimentally hurt you, okay, unless you're using synthetic, all right? It might detrimentally hurt you, but you can do it. You have control, right? And so we have control over variable factory overhead. Right? And so variable factory overhead, controllable variance, is the difference between the actual variable factory overhead, okay, and the budgeted variable factory overhead, right, for the current production. So if you remember, we're only doing 4,000 hours instead of the 5,000 hours. Right? And so in looking at this, we do our calculation, the budgeted variable factory overhead, okay, we're going to take the standard hours for actual units produced, right? And we're going to multiply that times the variable factory overhead rate. And so we do our calculations, right? And, you know, we had our totals, okay? We have our variable factory overhead and our fixed factory overhead. These are our actual costs. And so when we're looking at the controllable variance, we're just looking at the variable side of things, all right? And so we have the 10,400 coming from up there. That's what actually happened, right? And then we have the $14,400. Where did we get that number? Okay. Well, if you remember, okay, we took our 4,000 direct labor hours and we multiplied it times, right, the variable factory overhead rate. And so that's where this number came from. And that ended up, right, being a 4,000 variable. See, we thought in order to make 5,000 pairs of jeans, we're going to use variable factory overhead of 14,400. We only used 10,400. So we were under budget by 4,000 units. Well, with the controllable variance, all right, the variable factory overhead controllable variance indicates the ability to keep the factory overhead costs within budget limits. Because variable factory overhead costs are normally controllable at the department level, all right, responsibility for controlling this variance usually rests with the department supervisors. However, okay, we have the second part, right, which is the volume variance. And so whenever you hear volume, I want you to think of fixed factory overhead, right? So volume, think fixed factory overhead. When you hear controllable, I want you to think of variable factory overhead. That will definitely, hint, hint, help you on the exam. All right. And so here's the deal. Okay. At normal capacity, or 100%, okay, we thought we were going to produce 6,000 pairs of jeans, right? How many did we do? We did 5,000. Why? Well, because the demand, the volume of demand was not there to produce 6,000 pairs of jeans. So from management's perspective, how does that make you feel? I hope it doesn't make you feel very good, right? And I've used this earlier. If you don't feel good, that's unfavorable, isn't it? Right? And that really is what's happened here. See, fixed is fixed, right? It doesn't matter. It doesn't mean, fixed doesn't change with volume, does it? Right? It doesn't matter that we produced 5,000 pairs of jeans when we thought we were going to produce 6,000, right? Fixed is going to stay fixed. And if you go actually back and look at that that flexible budget, you can see that fixed does not change when volume changes. And again, that's within the relevant range. Right? And so the volume variance measures the use of fixed overhead resources, the plant and equipment. And so if you're producing less, right, than what we thought, that's not favorable. The interpretation of an unfavorable and favorable fixed factory overhead volume variance, right, again, has everything to do with your volume. Okay? An unfavorable fixed factory overhead, right, and that's what we had, right, because we were producing less than 100%. If we produced over, and can we produce over? Yes, because there is a difference between the normal capacity and theoretical capacity. So it is possible, right, to be more, okay, than normal capacity. And so in looking at these things, we're basically going to say, hey, we had the difference between our direct labor hours. Okay, we had, at our standard, okay, what we thought we were going to do, the normal capacity, 100% of normal capacity, okay, where we only actually use the 4,000. So it's 1,000 units, direct labor hours, okay, times the fixed factory overhead rate, $2.40. And so we end up, all right, with an unfavorable 2,400. So we had the favorable 4,000, we have the unfavorable 2,400, okay, and that actually equals, right, if you remember, the total factory overhead cost variance. And so some of the reasons unfavorable volume variance may be due to failure to maintain an even workflow, machine breakdowns, all right, and really I think probably the most common one, all right, is demand, right? So, you know, lack of orders to keep the factory operating at its normal capacity. And so we see that the total factory overhead cost variance, if you remember, that one was favorable, right? 1,600. It's made up, right, of the controllable variable cost and the volume fixed cost factory overhead, right, gives us the total. So factory overhead cost variance report is useful in management and controlling factory overhead costs. Budget and actual costs for variable and fixed, right, factory overhead along with the related controllable and volume variances are reported by each cost element. And so here's an example, right? And so really we're looking at the difference between this 4,000 and the 2,000, okay, giving us, you know, this right here. And so factory overhead account, right? If you remember, okay, we talked about this back when we were talking about you know, job order costing and process costing. You know, this was actual, and this was applied. And really, what we're going to see, right, is that, you know, this favorable and unfavorable factory overhead variance really ties directly, right, to over and under applied factory overhead, because we have actual, you know, so if we had something here, okay, that means it's under applied, isn't it? If we had something on the credit side, that would have been over applied factory overhead. And so they're basically doing the breakdown here, right? They're saying, hey, our applied factory overhead, right, the standard hours for actual units produced, right? So our standard hours were actually 4,000, right, times the total factory overhead rate, okay, of $6 gave us the you know, applied factory overhead. This was $24,000, where our actual, if you remember, was only the 22,400, or the actual 22,400. And so if we look at this, right, we, in this case, right, you know, we didn't have a balance on the debit side. We had a balance on the credit side. Okay. Guess what that amount is? Yes, it's 1,600. Just the difference with it. That's over applied factory overhead. Check this out right down here. Okay. That's the favorable variance that we reported. Okay. So at the end of the period, factory overhead is usually closed out, right, to cost of goods sold or prorated, right? And so under applied factory overhead occurs when actual factory overhead costs exceed the applied, right? And then the over applied was the example that we had down here, the over applied and the under applied. The difference between the actual factory overhead and the applied factory overhead is the total factory overhead cost variance. Thus, under and over applied factory overhead, right, represents the following total factory overhead cost variance, right? And so this is just repeating, right? The under applied and the over applied. And we just saw that. I did that. I guess I should have looked forward and see if they actually write that out for us, right? Okay. All right, so factory overhead account, the variable factory overhead controllable variance and the volume variance can be computed by comparing the factory overhead account with the budgeted total overhead for the actual level produced. And so they're just showing you, how we calculated the controllable and the volume. And the difference between those two, right, gives us this one, which is the same thing as this. And so, how do we use these? All right. Well, we can incorporate these standards in our normal journal entries. Again, these would be companies that utilize a standard cost system. Right? Standard cost may be used as a management tool to control costs separately from the accounts in the general ledger. Okay? However, many companies include standard costs in their accounts. And so here's an example where they are including it. So assume that Western Rider purchases on account the 7,300 actual yards, right, of blue denim at $5.50, right? So that was the actual. Right? That is what we're actually going to have to pay, right? So if you remember, this was our actual cost. Okay? Where we budgeted or we recorded in our books, right, the materials, we brought that in at the standard. Well, the difference between the materials at the standard price of the actual quantity, this is that middle column, right? The difference between that ends up in a price variance of this 3,650. We do the same thing then when we put it into work in process, so we're moving this from raw materials into work in process, right? So we're debiting work in process and we're crediting raw materials, okay? Raw materials. But we bring that in, right, at their standard cost, right, at actual units, okay? Right? And this is budgeted and budgeted. So again, we end up with the quantity variance or the efficiency variance. And so the benefit of this, all right, and I'm not going to go into much more detail than that, but the benefit is if we're recording these on a daily basis, anytime a deviant, all right, or a variance pops up, okay, we have the ability to change things, don't we? All right. And so in this case, we have the quantity variance, right? We probably wouldn't want to change this, but we'd say, hey, why are we using less material than we thought? Well, again, if you don't know to ask, right, you can't inquire, right? So this is just something that will highlight or allow you to control your costs from a managerial perspective much easier and better. And so, you can go ahead and do the same thing with the other variances, right? With wages, right? With factory overhead, and they just are showing you how you come up with those calculations. Okay. At the end of the period, the balances of each variance account indicate a net favorable or unfavorable variance, okay, over and under budget. Okay. And you can put this all together into a budgeted, or I should say a variance income statement. Okay. And so that's what we're doing here. So we take the sales, all right, the actual sales, okay. We compute the cost of goods sold at standard. But then, using the different favorable and unfavorable variances, okay, we adjust this number here down to this number here. This is the actual from what we thought was going to happen, right, or our budgeted gross profit, okay, down to the actual gross profit of $38,950. And then these other expenses would be similar. And so variances are not reported to external users. This is just used for internal purposes, managerial decisions and whatnot. Right? Yeah. And so there are other performance measures, okay, that aren't related to dollars. Okay? And those are obviously non-financial performance measures. Okay? Expresses performance measurements in different ways. Okay? And so you could look at, and a lot of these things are the touchy-feely or the customer service stuff. Okay? And so such measures are often used to evaluate the time, quantity of a business activity, right? And so I actually, when I was in high school, I worked at Wendy's, right? And Wendy's, we're going to use this example here in a second, right? Had different various inputs, right? and they related to them to outputs. Okay? And so these are just some examples of non-performance measures, but as you can see, a lot of them has to do with customer service, right? On-time delivery, right? Elapsed time customer orders and product delivery, customer preferences against your competitors, response time, time to develop new products, employee satisfaction, number of customer complaints, right? So a lot of these things are, like I said, customer service issues, right? So looking at non-performance measures, right, we can identify processes, right, and the inputs and the outputs from those processes and tie performance to them, right? And so, the relationship between a process and its inputs, okay, so we have inputs come into an activity or a process and lead to outputs, right? And so we're going to look at a fast food restaurant, okay? And if you remember, I just said it, I used to work at Wendy's, right? And this held true, right? So there's various different inputs, right? The number of employees. Okay? So there's some times that I worked, in the evenings, which, are sometimes relatively slow, until a bus rolls in, right, from a sporting event or something like that. And, I remember this one night, there was like 3 people working behind the counter, all right? And we had 4 buses pull in, all right? It was a large school, Kalamazoo Central or something like that. And they were coming back from a game and they pull into our Wendy's, all right? And we're like, oh my gosh, we do not have enough employees, okay? So if that's the case, all right, the outputs, right, are going to definitely impact the line weight. So there's a positive and a negative thing. We obviously didn't have enough in that situation. But I've also been there when we've had too many employees, all right, where, people were bumping into each other and our efficiencies went down, all right? And so even when we have too many employees, it can ultimately affect, all right, the outputs. Employee experience, so thankfully, when we had those 3 people, we had, I think it was me, a manager, and some other person that had been working there for a long time. All right. And so we were able to bust our butts because of the experience. All right. We still had longer lines, okay, but because of the experience, it was better than not having, brand new. If we had 2 brand new people and myself, I'd probably walk out or something. I don't know. All right. And then in training, fryer reliability, number of new menu items. All right. Believe it or not, I don't know if you've ever had a baked potato from Wendy's, right? But I actually worked for Wendy's when they introduced the baked potato. Yeah, that was 100 years ago. All right, but when we had that, all right, first of all, the people that we interacted with, our customers, right, they were kind of excited about that, right, because they were really good. All right, so that was a benefit, right, as far as the satisfaction of our customers. Right? But then there also was a learning curve of learning how to make those baked potatoes, right? And so the idea, all right, is the inputs, okay, lead to the outputs. Okay? And usually you can tie those things, even non-financial things, all right, to an activity, all right. And in this case, it was the counter service for a fast food restaurant. And that is the end. Right? And so I hope you guys, if we in class or online, we'll have time for questions and answers. But until then, I look forward to seeing you guys.